I'm going to speak in English, so I hope you will understand me. I will speak quite slowly. My name is Malie Conway. I'm co-CIO at ROGEE Global Partners. I've been at the company for 16 years, and I've been in the market for 27 years. I started my career at ROGEE Investment Management in London, and I specialize in fixed income. So the question is how to make money in a fixed income environment where yields are very, very low, and potentially inflation can go up, and how do you protect yourself in an environment where interest rates are very, very low. So you've seen this chart before. My previous presenter showed how rates have gone down quite dramatically. And if you wanted to invest in a fixed income environment, this is what you're getting today. If you invested in global bonds, you will get less than 1%. If you invested in corporate bonds, which is slightly higher risk, you will get 2.5%. If you invested in equities, your dividend yield is roughly 2.4%, so not very exciting. And if you invest in real estate, you can get roughly 4%. Why real estate and why now? The good thing about real estate is traditionally it's been a very, very good protection against inflation. You usually see real assets increase in value when there is inflation. So that's one reason why to do that. Why in particular commercial mortgage-backed securities? Most of the structures are floating rate notes. So if rates go up, within 3 months, the coupon adjusted on the bond increases accordingly. So you're not taking interest rate exposure. So when yields go up, the price of the bond does not go down. You get a floating coupon which readjusts. You also have a real estate market that was, as you all know, after the global financial crisis, there was a lot of revaluations, there was a lot of distress in the market. And when there is distress, there's usually opportunity. And that is really what we're trying to take advantage of. You'll get higher yields in corporate bonds, and you will get much lower volatility due to the fact that the bonds are floating rate notes. You can see for yourselves where you can invest. Commercial mortgage-backed securities will give you roughly 2 to 15%, depending where you are in the capital structure. This particular strategy is supposed to be investment grade strategy, so it's the lowest risk in terms of the capital structure if you were to invest in mortgages in the bond market. If you invested in direct real estate, which to be honest, it's probably your best exposure, is to actually go and buy the real asset, but you will pay significant, well, first of all, it's quite a significant investment. Second, it's tied up between 5 and 7 years. And thirdly, you need to actually manage it, which is quite complicated. So what this strategy will give you is what I call a liquid alternative to investing in the real estate market. And I must stress, this is a global real estate market, and it's commercial real estate market. It is not residential. So, as I alluded before, the financial crisis has created a lot of price dislocation. We've seen the US market recovering, but we still have a lot of dislocation in the European asset class, and we're trying to take advantage where there are dislocations on the global market. We're not exposed in this strategy at the moment to Asia, nor to China, but if there was a distressed market, which there will at some point, we will look to give exposure to this fund there. What do you own in this strategy? You own prime property, you own Time Warner, you own Commerzbank real estate branches, you own property in London. These are all prime properties, commercial prime properties, which are very, very big properties with a very low loan to value, roughly around 60% on average. What are we investing in? This strategy invests in commercial mortgage-backed securities, and I have to stress, it has to have short duration. The average life of the fund is roughly, the strategy is roughly 3.5 years, and the interest rate exposure that you're taking is less than 2 years. Who manages the fund? So I personally manage the strategy, and as we were told yesterday, I have to disclose, I actually have all of my cash invested in this portfolio. in this strategy. What's unique about this strategy is that we teamed up with a global real estate company. What we do is we look to identify the bonds that the underlying security of those bonds are the properties that you've seen before. We then do the analysis of the structure of the bonds, the waterfall, how much mortgage there is, what the loan to value is. But that's not enough. What you need to know, and what's the key to the strategy, is the value of the assets. How much is that building really worth? And not by the service, not by the reports that you get from the rating agencies. So we teamed up with Heitman, which is a global real estate company, which actually is a company that goes and buys directly those properties. So we will analyze the bonds, we will ask them to go and check each property and give us the value of the property. Not only do we ask them to give us the value of the property, they have to give us 4 scenarios of the value of the property. So if the current value, let's just say, is $800 million, what would the property be worth under a severe stress scenario and under a severe fire sale? What would that be worth today? And only if that value covers the loan by 1.2 times, we will engage in buying that particular property. So you can see the strategy of the CMBS. It's a short duration strategy, so we compared it to alternative asset classes within the fixed income world. It gives you a lot higher return than a US domestic properties if you were only investing in US domestic properties. It gives you a higher return than investment grade corporate, so a good company like Deutsche Telekom, for example. And it gives you a much better return than a high yield company, a company which is considered to be quite risky. The strategy, you can see the statistics on the strategy. You can see where it's invested at the moment. And the key to this strategy is that the average rating has to stay A- or better. So this is a very high quality portfolio. The strategy also provides, unlike other strategies that you've seen today, a weekly liquidity. This is very, very key. This is an asset class which is not very liquid, and this is an alternative way to go and access big, large portfolios on a very liquid basis. You can see that it invests globally, so the currency is broken into dollars, euros, and sterling. It's all fully hedged into dollars, so you'll get your returns in dollars. Geographic breakdown is considerably wide at the moment. We are looking at investing in peripheral Europe, such as Italy and Spain, but we've yet to find really good properties where we think that that's the next wave. We've yet to find properties that fall into the criteria of this strategy. And you can see that almost 85% of the portfolio is invested in floating rate notes. So again, very little exposure to rates if interest rates go up. And you can have your own view about interest rates and inflation, but this is one way to protect yourself against the possibility of higher rates and higher inflation. You can see the breakdown in terms of ratings. So again, I repeat, it's extremely, extremely strong credit quality. It's a very well diversified property strategy. So you get diversification globally, you get diversification within the commercial real estate market. So it's not concentrated just to offices, it's not concentrated just to hotels, and we take very active decisions of where to be across that spectrum. What spreads do you get? What yields do you get? So you can see the portfolio there is roughly 360 basis points. So if nothing happens to this portfolio, you will get 3.6% on an annual basis. We expect that to contract quite substantially and to move towards the double B, so 241 basis points. So a contraction of roughly 100 basis points, which will give you a capital gain. Hence, we come up with a return of roughly 4 to 6% for the portfolio. So my messages today are very simple. Very little exposure to interest rates. It's within the fixed income world, but it's accessing an alternative asset class which tends to be quite illiquid and quite long-term. It gives you protection against inflation and interest rates, and if nothing happens to the portfolio, if literally nothing happens and there is inflation, the loan to value of the portfolio will be reduced, hence the quality of the portfolio will be better. And what should happen in the market, the pricing should reflect that. It has liquidity, it has a weekly liquidity, and it's versus direct real estate investment. It has higher yields than corporate bonds, and obviously against government bonds, and it has lower volatility to equities. So you should think about, if I wanted to invest in real estate, what is the map, where are my alternatives, and where do I want to be on the volatility and return spectrum?